Listen carefully, because what I am about to explain is not a routine market forecast, and it is certainly not another short-term prediction designed to capture attention for a few days before disappearing into the background noise of financial headlines. I am talking about something far more significant. I am talking about a rare monetary shift that may already be unfolding beneath the surface of the global economy, a shift that most investors still fail to recognize. And if you misunderstand what is happening now, you may completely misjudge what silver could represent in the years ahead. Most people continue looking at markets through a narrow lens. They focus on economic reports, interest rate announcements, quarterly earnings, or temporary fluctuations in asset prices. But the largest wealth transfers in history rarely begin with a single event. They emerge from structural pressures that accumulate over years, sometimes decades, until the system reaches a point where old assumptions stop working. When that happens, capital begins moving differently. Investors start questioning beliefs they once considered permanent. Assets ignored for years suddenly attract attention, while assets that seemed untouchable begin losing the confidence that once supported them. That is why I want you to understand what is happening today. When Ray Dalio studies financial history, he is not simply looking at recessions, market crashes, or political events. He studies the deeper forces that shape entire economic eras. He studies debt cycles. He studies monetary systems. He studies how nations behave when obligations expand faster than productive growth. He studies the patterns that appear repeatedly whenever governments become increasingly dependent on debt, liquidity creation, and financial intervention to maintain stability. Those patterns are becoming impossible to ignore. This is not speculation. This is not emotional fear. This is an examination of structural reality. For decades, the global financial system operated under conditions that encouraged borrowing at every level. Governments expanded deficits. Corporations refinanced debt repeatedly. Consumers became accustomed to credit-driven lifestyles. Central banks lowered rates whenever economic weakness appeared. Liquidity became the solution for nearly every problem. Because the system continued functioning, most people assumed it would continue functioning indefinitely. But history shows that no debt-driven expansion lasts forever. Debt can be productive when it finances growth that generates future income. It can support innovation, infrastructure, and economic development. The problem emerges when debt begins expanding faster than the productive capacity needed to support it. At that point, leverage stops strengthening the system and starts weakening it. The appearance of stability remains intact, but the foundation becomes increasingly fragile. Eventually, policymakers face a dilemma. If they maintain restrictive monetary conditions, they risk exposing weaknesses hidden beneath years of debt accumulation. Higher financing costs pressure governments, corporations, consumers, and financial institutions simultaneously. Economic growth slows, defaults increase, liquidity tightens. Stress spreads through the system, but if they respond with easier monetary policy, they create a different problem. They encourage further debt expansion while reducing the purchasing power of the currency itself. The burden becomes easier to manage in nominal terms, but the value of money gradually erodes. History has demonstrated repeatedly that heavily indebted systems rarely resolve these pressures through austerity alone. More often, they rely on policies that reduce the real value of obligations over time. The methods vary. Sometimes inflation plays the central role. Sometimes financial repression becomes the preferred approach. Sometimes monetary expansion accelerates under different names, but the outcome follows a familiar pattern. The value of money changes. Most people miss this because they focus on nominal numbers. They see rising account balances and assume wealth is increasing. They see asset prices climbing and assume purchasing power is protected. But the true question is not how many currency units exist. The true question is what those units can buy. That distinction becomes extremely important during monetary transitions. As confidence in long-term currency stability begins weakening, investors start looking beyond traditional financial assets. Capital searches for alternatives that cannot be expanded through policy decisions. This process has appeared throughout history whenever debt burdens reached extreme levels and monetary authorities became increasingly dependent on intervention. And this is where silver becomes remarkably important. Many investors still misunderstand silver because they evaluate it through outdated frameworks. Some see it purely as an industrial metal. Others dismiss it as a volatile commodity. Both views overlook the unique role silver occupies inside the global economy. Silver exists at the intersection of industry and money. That dual identity matters more than most people realize. On one side, industrial demand continues growing as the world becomes increasingly dependent on electrification, advanced technology, renewable infrastructure, artificial intelligence systems, data centers, communications networks, and sophisticated manufacturing. Silver possesses properties that make it exceptionally valuable across these industries. Its conductivity remains unmatched. Its applications continue expanding. Its role within modern technology becomes more important as global development accelerates. This is not temporary demand. This is structural demand tied directly to how the modern economy is evolving. But industrial demand represents only half the story. The other half involves monetary history. For thousands of years, societies recognized silver as a store of value. Long before modern central banking existed, silver served as money across civilizations, preserving purchasing power through periods of instability, political change, monetary restructuring, and economic uncertainty. That legacy still influences investor behavior today. Whenever confidence in financial systems weakens, investors begin reconsidering tangible assets. They begin looking for scarcity. They begin looking for durability. They begin looking for assets that exist independently from government promises and central bank balance sheets. Silver shares those characteristics. Its supply cannot be expanded through monetary policy. It cannot be created with a keystroke. It cannot be produced through financial engineering. New supply requires exploration, investment, energy, labor, infrastructure, and time. That limitation becomes increasingly important when monetary creation grows faster than real-world production. Now think carefully about what happens when these forces begin operating simultaneously. Industrial demand rises because the world requires more silver for technological transformation. Monetary demand rises because investors seek protection against declining purchasing power. Two entirely different sources of demand begin targeting the same finite asset. And that is when markets can begin moving in ways that surprise almost everyone. Most major repricing events do not begin when the crowd notices them. They begin when underlying conditions shift long before public awareness catches up. A small group recognizes the imbalance first. Institutional capital starts adjusting gradually. Broader investors follow later. By the time the majority understands what is happening, the process is already underway. That is why I believe this moment deserves serious attention, because what we are witnessing may not simply be another commodity cycle or another temporary rally. We may be entering the early stages of a rare monetary transition where debt burdens, currency pressure, industrial demand, and investor psychology converge around one asset in a way that history has shown can produce extraordinary outcomes. And the signals supporting that possibility are becoming harder to ignore with every passing month. Now the question becomes larger than silver itself. You need to understand why the signals emerging today matter so much, because silver is not acting in isolation. What we are seeing is a reflection of pressure building across the entire financial system. Silver is simply one of the assets beginning to respond to those pressures before most investors fully recognize what is happening. When debt levels remain elevated for long enough, economies become increasingly dependent on liquidity. That dependency changes everything. Governments become more sensitive to rising borrowing costs. Financial institutions become more vulnerable to tighter conditions. Asset markets become increasingly reliant on monetary support. Policymakers lose flexibility because every decision carries larger consequences than before. This is one of the defining characteristics of a late-stage debt cycle. The system appears stable on the surface, but stability depends on conditions that become progressively harder to maintain. Over the past several decades, every major economic slowdown has been met with larger interventions. Interest rates moved lower. Liquidity injections became bigger. Balance sheets expanded further. Each cycle required more support than the one before because leverage throughout the system continued increasing. That pattern matters. When markets become accustomed to intervention, they begin pricing assets based not only on economic fundamentals, but also on expectations of future support. Investors assume liquidity will arrive whenever stress appears. Governments assume refinancing will remain available. Financial institutions assume central banks will step in when instability grows. But there is a problem with this arrangement. Eventually, policymakers face limits. They cannot raise rates indefinitely because debt servicing costs become unsustainable. They cannot print indefinitely without affecting purchasing power. They cannot maintain both currency strength and unlimited monetary accommodation at the same time. At some point, difficult trade-offs emerge. This is exactly the type of environment where tangible assets begin attracting serious attention. Not because investors suddenly become fearful, not because financial headlines become dramatic, but because preserving purchasing power becomes increasingly important. History has proven this repeatedly. Whenever real returns on traditional savings become less attractive, investors start searching for alternatives. When inflation remains persistent while nominal returns struggle to compensate, confidence in conventional wealth preservation strategies begins weakening. That shift often happens gradually at first. Most people continue following familiar patterns because they assume the future will resemble the recent past. They trust the institutions they have always trusted. They hold the assets they have always held. They expect the same financial relationships to continue functioning exactly as they did before. But monetary transitions rarely announce themselves clearly. They develop beneath the surface, they build quietly. Then suddenly the narrative changes. Assets previously ignored become important. Risks previously dismissed become obvious. Opportunities that appeared insignificant begin attracting attention from increasingly larger pools of capital. This is where silver becomes especially interesting. Unlike many financial assets, physical silver carries no dependence on promises made by governments, banks, corporations, or institutions. It does not represent a liability owed by someone else. It does not rely on a future payment stream. It simply exists as a scarce tangible asset. That characteristic becomes increasingly valuable when trust begins eroding inside the broader financial system. But silver possesses another advantage that few assets can claim. Its industrial importance continues growing simultaneously. Think about the scale of global transformation currently underway. Nations are investing heavily in energy infrastructure. Manufacturing systems are being modernized. Artificial intelligence requires enormous computing capacity. Data centers continue expanding. Electrification initiatives are accelerating across multiple industries. Advanced electronics are becoming integrated into nearly every aspect of economic activity. Silver sits directly inside many of these trends. The world is demanding more conductive efficiency, more technological sophistication, more electrical infrastructure, more advanced manufacturing, and silver remains one of the most important materials supporting those developments. This creates an unusual dynamic. Normally, monetary assets and industrial assets respond to different forces. Silver responds to both. That means two separate demand drivers can strengthen simultaneously. Industrial buyers need silver because modern technology depends on it. Investors want silver because monetary conditions increasingly favor scarce assets. When both groups move in the same direction, market conditions can change rapidly. Supply becomes extremely important under those circumstances. And this is where many investors underestimate the situation. Silver production is not infinitely flexible. New supply cannot appear overnight simply because demand increases. Mining projects require years of development. Exploration takes time. Permitting takes time. Construction takes time, capital investment takes time. Even higher prices do not immediately create significant new supply. That lag can produce substantial imbalances whenever demand accelerates faster than production capacity. Most people assume markets adjust smoothly. History suggests otherwise. When supply constraints meet rising demand, price discovery can become surprisingly aggressive. The process usually begins quietly. Inventories tighten. Market participants notice subtle changes. Institutional buyers adjust allocations. Strategic investors increase exposure. Then broader awareness begins spreading. By the time headlines start discussing the move, much of the underlying shift has already occurred. This is why understanding cycles matters so much. Ray Dalio often emphasizes that major economic changes follow recognizable patterns. The details vary from one era to another, but the underlying dynamics remain remarkably consistent. Debt expands. Confidence grows, leverage increases. Imbalances accumulate, policymakers intervene, debt expands further. Eventually, the system reaches a stage where maintaining stability requires increasingly aggressive measures. That stage creates pressure on currency purchasing power, and that pressure often redirects capital towards scarce assets. History contains numerous examples, different countries, different decades, different monetary systems, yet the sequence appears again and again. Investors who recognize the pattern early position themselves differently than those who wait for universal confirmation. The majority usually demands proof. They want consensus agreement. They want institutional validation. They want certainty. But certainty rarely exists before major market shifts. By the time certainty arrives, the opportunity has often changed dramatically. That is why the current environment deserves careful attention. Global debt remains extraordinarily high. Fiscal deficits continue expanding, demographic pressures are increasing, government obligations continue growing, geopolitical fragmentation is creating inefficiencies across international trade, supply chains are becoming more complex. Financial systems remain heavily dependent on liquidity support. None of these developments exist in isolation. They reinforce one another. They create structural conditions that resemble other periods of monetary stress throughout history. And during such periods, investor behavior tends to change. The focus shifts away from maximizing returns at all costs. The focus shifts toward preserving purchasing power. The focus shifts toward assets with scarcity, credibility, and independence from monetary expansion. Silver fits directly into that conversation. The real question is not whether short-term volatility will occur. Volatility is inevitable. The real question is whether the structural forces supporting silver are becoming stronger or weaker over time. When I examine the debt cycle, monetary policy constraints, industrial demand growth, fiscal expansion, and long-term purchasing power concerns, I see pressures that continue building rather than disappearing. That does not guarantee a specific outcome tomorrow, but it does suggest that the foundation beneath the silver market may be changing in ways most investors still fail to appreciate. And if that assessment proves correct, then what appears today as a relatively overlooked asset could eventually become one of the most important monetary signals of the coming decade. Now, I want you to step back and look at the bigger picture, because this discussion is not ultimately about silver. Silver is simply the lens through which a much larger transformation is becoming visible. Most investors still believe the future will resemble the environment that shaped the last several decades. They assume central banks can continue stabilizing markets whenever problems emerge. They assume governments can continue expanding deficits without meaningful consequences. They assume debt can keep growing faster than economic output indefinitely. History does not support those assumptions. Every monetary system eventually reaches a stage where confidence becomes the most important variable. As long as confidence remains strong, imbalances can persist much longer than expected. Debt can expand, deficits can widen, liquidity can increase. Asset prices can continue rising, but once confidence begins weakening, even gradually, behavior changes. Investors start asking different questions. They stop focusing exclusively on returns. They start focusing on preservation. They stop asking how much money they can make. They start asking how much purchasing power they can keep. That shift is often subtle in the beginning. It does not arrive with a single announcement. It emerges through thousands of decisions made by investors, institutions, corporations, and governments responding to changing conditions. You can already see evidence of this shift forming. Concerns about sovereign debt sustainability continue increasing. Questions surrounding long-term currency purchasing power continue expanding. Central banks around the world remain trapped between inflation pressures and financial stability concerns. Governments continue spending aggressively despite already elevated debt burdens. Geopolitical tensions are reshaping trade relationships. Supply chains remain vulnerable. Energy systems continue undergoing transformation. Stock investment requirements continue growing. All of these forces require financing, and that financing increasingly depends on additional debt. This creates a feedback loop. Higher debt levels encourage lower real rates. Lower real rates weaken purchasing power. Weaker purchasing power increases demand for scarce assets. Rising demand for scarce assets reflects declining confidence in fiat stability. That process does not happen overnight, but it rarely reverses quickly once it gains momentum. This is why studying long-term cycles matters so much. Short-term headlines create distraction. Long-term structural trends reveal direction. And the direction of many major trends appears increasingly aligned. Debt continues rising. Monetary flexibility continues shrinking. Fiscal obligations continue expanding. Industrial demand for critical materials continues increasing. Investor awareness surrounding purchasing power risk continues growing. Silver sits directly at the intersection of those realities. That is what makes the current situation so unusual. Most assets benefit from one major driver. Silver may benefit from several. Industrial demand supports it. Monetary demand supports it. Scarcity supports it. Supply constraints support it. And growing concerns regarding currency debasement support it. When multiple structural forces begin reinforcing one another, outcomes can become far more powerful than traditional models anticipate. This is where investor psychology becomes critically important. Markets are not driven solely by economics. They are driven by perception. For years, silver remained largely ignored by much of the investment community. Attention flowed elsewhere. Capital pursued technology, growth assets, speculative opportunities, and sectors benefiting directly from abundant liquidity. But perceptions can change rapidly. Once investors begin viewing silver through a different framework, demand can accelerate unexpectedly. The metal stops being viewed merely as a commodity. It begins being viewed as a strategic monetary asset. That shift alone can alter capital flows dramatically. Institutional investors begin reassessing allocations. Wealth preservation strategies evolve. Retail participation increases. Broader awareness spreads. Each stage reinforces the next. Because silver remains relatively small compared to global capital markets, it does not require enormous flows to create significant price movement. That is an important point many people overlook. A relatively small reallocation of global capital towards silver can have an outsized impact because the available market is limited. This is one reason why historical silver repricing events have often surprised investors. The move appears impossible beforehand, then suddenly it appears obvious afterward. That is how many major transitions unfold. The crowd sees the result before understanding the cause. But those who study the structure beneath the surface often recognize the process much earlier. Now consider the possibility that Ray Dalio's broader warnings regarding debt cycles and monetary transitions prove substantially correct. Consider the possibility that debt burdens continue expanding faster than productive growth. Consider the possibility that governments increasingly rely on monetary accommodation to maintain stability. Consider the possibility that investors gradually lose confidence in the long-term purchasing power of fiat currencies. If those developments continue, the environment supporting scarce monetary assets becomes significantly stronger. And if industrial demand continues expanding simultaneously, the conditions become even more compelling. This is why some analysts believe silver could eventually experience a repricing event far beyond what most investors currently consider possible. Whether any specific target is reached is not the central issue. The central issue is understanding the forces involved, because once structural shifts begin, markets often travel much farther than consensus expectations suggest. History has shown this repeatedly. Major turning points rarely feel obvious in real time. They become obvious only after the transition is already underway. That is why paying attention today matters. Most people will wait. They will wait for certainty. They will wait for headlines. They will wait for broad agreement. They will wait until prices have already moved substantially higher. Then they will ask what happened. But by that stage, the most important part of the opportunity may already be behind them. The investors who benefit most from major macroeconomic transitions are usually not the ones reacting to the outcome. They are the ones who understood the process before the crowd recognized it. And that is the message I want you to remember. Silver is not simply a metal, it may be a signal. A signal that deeper monetary pressures are emerging beneath the global economy. A signal that debt-driven systems are entering a more difficult phase. A signal that purchasing power may become one of the defining financial concerns of the years ahead. And if that signal continues strengthening, the repricing that follows could be far larger than most people currently imagine.